But there was something else that the Federal Reserve said yesterday that could be cause for concern over the longer term. Steve Liesman explains.
When it comes to the economy over the next several years, what you see is what you get as far as the Federal Reserve is concerned. The unemployment rate, it's 5.1% now, and the Fed's latest forecast is it will only fall ever so slightly to 4.8% and stay there through 2018. Inflation? The Fed has been aiming for and missing a 2% target for several years. It's going to miss it for several more. The latest forecast doesn't see 2% inflation until 2018. The big news yesterday? The Fed isn't even sure of that. It held off on raising rates because of concerns that weak overseas growth could drag down the U.S. economy and inflation.
We've long expected, as most analysts have, to see some slowing in Chinese growth over time as they rebalance their economy. And they've planned that, and I think there are no surprises there. The question is whether or not there might be a risk of a more abrupt slowdown than most analysts expect.
How about the Fed's growth forecast? Gross domestic product, which has been a disappointing 2% since the end of the Great Recession, will remain, the Fed says, an unremarkable 2% through 2018. Gone are the days when the Fed forecast acceleration in growth that approached 4%. Still, Yellen said that if it were just focused on the U.S. economic data, it's good enough for the Fed to have raised rates already.
The U.S. economy is reasonably healthy. The job market is good. Overall consumption should be good. The problem is the remaining part of the economy, capital spending and net exports, that remaining 25% rather, is going to look horrible.
It's worth remembering, as lackluster as the U.S. numbers may be, they're still better than Japan and Europe. For 90 Business Report, I'm Steve Liesman.